Hey there, students. My name is Nathan, and I am a Chegg tutor. Today we're going to be talking about liquidity. Now, what is liquidity? I'm sure you've heard that word before, liquid. Well, in accounting, it means how easily can an asset be converted into cash. The more easily it can be converted, the higher the liquidity. And so there's two main ratios that help measure this. The first one is called your current ratio. And pretty much this is how easily can you pay off current liabilities with current assets. So how easily can you pay off current liabilities with current assets? So pretty much financial analysts want to know how well is a company leveraging their current assets to pay off these current liabilities. If the ratio ends up being over 1, that's fairly good. A company is highly liquid and they can pay off those current obligations fairly easily. Now, a more strict ratio for measuring liquidity is called the quick ratio. The quick ratio pretty much is how easily can current liabilities be paid off with the highly liquid assets. Now, in current assets, there's more assets that are liquid than others. So cash equivalents, and accounts receivable, those are the most liquid assets. And the ratio here is dividing the cash equivalents, and accounts receivable divided by current liabilities. So how easily can a company pay off those current liabilities just with cash equivalents, and accounts receivable? So those are the two main ratios here. Now let's go ahead and take a look at a practice problem, and you can see exactly how it works. So over here, on December 31st, 2014, Intertrode Incorporated had 10 grand in accounts receivable, 4 grand in supplies, 8 grand in cash, 20 grand in inventory, and 2,500 in prepaid insurance. Their accounts payable amounted to 28 grand. Interest payable was 3,200, and they also had revenues of 45,000 and expenses of 15 grand. So, for their current ratio, what do we need to do? Well, if we just follow this formula on the left side, take your current assets and divide it by your current liabilities. So, let's look at our current assets here. Well, we have 10,000 in accounts receivable. We know that. So let's go ahead and add that in here. And we have 4,000 in supplies, 8,000 in cash, 20,000 in inventory, and 2,500 in prepaid insurance. So we know that's going to be our numerator there. And we divide that over our current liabilities. Well, the only liabilities here that are reported are current. So they have accounts payable for 28 grand, interest payable for 3,200. So let's go ahead and add those up here. 3,200 plus 28 grand. Let's go and do the parentheses first. So 10 grand, 4 grand, 8 grand, 20 grand, and 2,500. So let's see here. 14,000, 22,000, 42,000, 44,500. Divided by, add those up, and we should get 31,200. So let's go ahead and divide those two numbers and see what we get. Okay, so they have a current ratio of 1.41. So it's definitely over 1, which is good. Another way to say this is that their current assets are 1.4 times the amount of their current liabilities. So they definitely have sufficient enough current assets to pay off those current liabilities. So that's the current ratio. So far, Intertrode Inc., they are fairly liquid. They can pay off their current obligations fairly easily with their current assets. Now for the quick ratio. Take our cash plus cash equivalents plus accounts receivable. And we divide that by our current liabilities. So our cash, if you remember, is 8,000. There is no cash equivalents in this example, but there is accounts receivable for 10,000. Divide that, current liabilities, which was 31,200. Okay, let's see what we get here. Okay, so we get about 0.58 as our quick ratio. So not as good, honestly, not as good. It's under 1. So what you're saying there is about these really liquid assets, cash, cash equivalents, accounts receivable, is about 58% of your current liabilities. Ideally, you want it to be over 1 to pay off those current liabilities fairly easily. Now, since they can't pay it off fully with their most liquid assets, they can go in and dip into the other types of assets we talked about on the current ratio. And that should be sufficient enough to pay off those current liabilities. So hopefully this was helpful for y'all today. Once again, my name is Nathan, and I am a Chegg Tutor. You can find me right here at this link. I go by Nathan G. So just go there if you need some homework help, exam prep, or one-on-one tutoring. I'll be there for you. Go to that link, send me a message, and we can start working together. Once again, thanks for listening today, and I'll see you in the next video.